Good afternoon, everyone, and welcome to the RealNex webinar series. Today we have special guest Dr. Jeffrey Fisher to talk about the CRE Market Outlook. How has CRE been performing so far in 2024? I'm Jeff Finn, CEO of RealNex. I'll be hosting Dr. Fisher today. It's always a delight to have Jeff with us as the Professor Emeritus of Indiana University Kelley School of Business. He is the head of data and research at RealNex and literally wrote the book on property finance with his co-author. Jeff wrote the Real Estate Finance and Investments book and Income Property Valuation. So always a pleasure to have Jeff. He's done a tremendous work with NCREIF to study and analyze commercial real estate markets for many years and leverages their data on active transactions in the market. So here we are 18 months or so more into a rate rising cycle, hopefully at peak rates. But the market seems to have lagged to some extent the impact of those rate increases. But obviously everyone on the call knows the impact in 2024 of transaction velocity down precipitously, valuations down. We have much stricter debt requirements from either loan to value or coverage ratios, and a looming wall of debt maturities coming before us. So we're going to be looking out into 2024, and as Jeff will talk about, trying to forecast how far do we have to wait to see the other side of this cycle that we're in. So Jeff, excited and anxious to hear what your findings are and what your outlook is as we enter into 2024. So I'm going to turn the stage over to you, and welcome.
Thanks, Jeff. Good introduction to sort of where we're at and what I'm going to try to do today. So, $1 million question. Are we going to bottom in 2024, or do we have to stay alive till 25, which is a mantra that I've been hearing a lot lately. And you know, I hear both in the market. Seems, just like I'm showing here, somebody on Bloomberg recently, not just anybody actually, somebody with Blackstone, the president of Blackstone, major player in commercial real estate, says values are bottoming. At the same time, somebody else to the right here, Ken McElroy, who I have to admit I don't know who that is. That's a blog, but says stay alive till 25, which I certainly have been hearing a lot. I think that was picked up from what Sam Zell, the late Sam Zell, used to say, stay alive till 95, which some of you may remember that are on the webinar. So I usually like to start off with a slide that shows the returns, not only for the more recent quarter, going through the end of the year 23, as well as going back a year, 10 years, and 30 years for some of the different asset classes that NCREIF, National Council of Real Estate Investment Fiduciaries, tracks. It's an organization of institutional investors that have private equity funds that I work with, and so I rely a lot on their data, although you'll see several slides that come from other sources, including some that were guest speakers on a similar webinar that I did a week ago. So got some slides from some other sources as well. But in terms of the indices that NCREIF tracks, to keep it simple, just think of the first one on the left that says NPI research as what's happening to private equity real estate that's held by institutional investors on an unlevered basis. And no surprise, the most recent quarter it was down 3%. For a year, it was down 7.9%. A lot of people were even questioning if that's reflecting what's really happening in the market. And actually, I'll get to that in some other slides that show some further declines in value based on some of the transactions that have been taking place. But we are negative, however you look at it, over the last year. And of course, on a levered basis, the next part of the chart that says NPI levered, it's even worse. because our returns are less than we're paying the bank. So leverage is hurting us right now. We can kind of skip some of the other ones that have to do with more with some of the funds and the returns on the funds, but it's pretty similar to what's happening with the properties. There is data that's collected on institutional ownership of farmland and timberland, which is interesting that those are in positive territory. S&P 500 did end the year and the quarter on a positive note, and as well as REITs. And one thing worth noting here is there's often a lot of people saying that REITs are a leading indicator of what's going to happen in the private market. I'm not sure I always agree with that. I think REITs have, forecast something like 10 of the last 6 recessions. So sometimes they do a good job of forecasting what's going to happen. Other times they give false signals. But REITs have turned positive. In fact, the market today is way up. I haven't looked at REITs today, but thanks to NVIDIA, we've got a really nice stock market today. So if REITs are a leading indicator, that's good news for the private equity real estate market turning around. But returns are in negative territory. I was kind of hoping it would be more like a V-shaped recovery. You see back with the recession that we had, the financial crisis in the 2008, 2009 time period, it was a V-shaped recovery. COVID, not as deep a V, but that was also a V-shaped recovery. And a couple quarters ago, I looked at this and said, oh, looks like we might have another V-shaped recovery, but it was starting to move back up towards positive territory and then dipped back into negative territory again, unfortunately. So maybe it'll be a W-shaped recovery, but at this point, no V in the word recovery this go around. But as we'll get to, I think most people think it will be, either later 2024 or early in 2025 that we will have a turnaround. So market values down about 14% from the peak. But if you take a look at properties that were actually sold out of the index this quarter, it's down 21% from the peak. And I'll have some other slides that look at what's happening with actual transactions as opposed to change in the appraised values. I don't know that means the appraised values aren't capturing the drop in value, because of course what properties are sold could be the distressed properties, and we are seeing that some of those properties in the CBD, the office buildings in particular that were hit the hardest are the ones that are being sold out of some of these portfolios. And so when we look at transaction prices, you get a sort of a worse indication of what's happening in the market. And of course, the media likes to pick up on that. But if we do look at those sold properties, which is a very small sample, I think there were in total about 90 properties in this database out of 10,000 properties that sold. But this is the percent decline from the peak that was in the second quarter of 2022. So you can see on a national basis, combining all the property sectors, it was down a little bit over 20%. I don't think, again, a surprise to many that office down 40%. Again, for those properties that did sell, those distressed properties, everything is down. Retail is down, even industrial. And although industrial not down as much, think of industrial as warehouse properties. It's basically all warehouse, Amazon and the other types of warehouse properties used for inventory and for online shopping. So the industrial had been doing the best of any sector for quite a few years, but sort of supply catching up with demand falling off a little bit. So even industrial is down a little bit. This is from CBRE, and they're showing the commercial real estate investment volume. And in fact, Jeff mentioned volume being down at the introduction. And so this kind of confirms that We're certainly down from the peak that we had back in the second quarter 2022. This chart corresponds a lot with what I was just showing previously, is what the peak of the market was, which was back 2022 first, second quarter, somewhere in that time frame, and we're certainly down. Although it looks like it's leveling off. The transaction volume has been about the same for the last 4 quarters, which is I think a good sign, and not down quite as much as we saw back during the COVID time period. This doesn't take us back to 2008 when the transaction volume would have been even a lot less. And they also showed in this report from CBRE the top 20 markets in terms of the transaction volume for 2023. So I thought it was just kind of interesting to see New York was the highest. And again, a lot of this could have been selling off properties that were in distressed situations. So New York, Los Angeles, Dallas, working its way down to San Antonio. Of course, ones that are not listed here would have had even less transaction volume in terms of the major CBSAs that you would expect would be tracked. There are write-downs being obviously being taken in a lot of these portfolios. So you can see here the red bars are the number of write-downs, which has been, I guess, stabilizing also the last couple of quarters. It certainly up from where it was back in 2022 when the market was doing a lot better, but at least although it's up a little bit this quarter, it's kind of back to where it was 3 quarters ago. So hopefully the number of write-downs will start to come back down again. It's sort of interesting if I look at the whole history of this index, which goes back to 1978. There were always some write-downs and some write-ups. So if you were at the right place at the right time in the right sector, you could still make money. I think that's probably always been true. It's always interesting to look at the components of return, the underlying drivers, because that kind of tells you, what is it that's really been impacting the returns the most. And by return, I mean, an IRR that you would have earned if you bought it at the beginning of each quarter and sold at the end of each quarter, because these properties are appraised every quarter, so that you can calculate a rate of return as if you were in for that quarter. And then they're linked together through time. So what's driving the returns? Is it the yield that you're getting when you buy the property? In other words, your NOI divided by your value, which is going to be reduced a little bit by any capital expenditures you make. Is it NOI growth? So the NOI is going up during the quarter. Or is it cap rate changes, which would be if cap rates went up during the quarter, that's going to hurt you, right? If cap rates go down during the quarter, that's going to help you because investors are paying higher value for the same net operating income at the end of the quarter. So you can see here the yellow being the cap rates, was helping us a lot up through the peak when returns were the highest, and then as the Fed was raising interest rates, the pressure that put on cap rates caused cap rates to pull values down. So the yellow bar is going down for the cap rates doesn't mean the cap rates are going down. It means the returns are going down because the cap rates are going up. So you can see it's really the cap rate change. It's what we call the capital market, the impacts to the Fed that's hurting us right now. The NOI growth has really held up pretty well. The gray bars, the NOI growth, it's not what it was during the time the market was really strong in 2021 and 2022, but it's not down that much. The NOI growth is still positive and at a decent level, and the going in yield is it still at a decent level? It's really the cap rate changes. So if interest rates do start coming down, if the Fed starts cutting rates, as is anticipated to happen a couple of times this year, the debate is more when, I think, although a couple of people lately have been saying, well, there could be a rate increase, but I think the consensus is still that there's at least a couple of rate cuts expected this year. And I would expect that that's going to start moving cap rates back down again, or at least even if the cap rates stay the same, they won't be hurting us. It's the cap rates going up that are causing the yellow bars to be in the negative territory and total returns to be down. So cap rates can just kind of hold steady or even go down a little bit, and NOI growth holds up. We're going to be in pretty good shape. So I mentioned this was more to introduce the members of the institutional investment organization that I work with, how their index is going to change. But I thought it'd be interesting to mention here because there's just a lot of interest in what might be called alternatives. In fact, the picture on the left was from CNBC talking about alternatives in terms of investing in stocks, but we're also talking about alternatives being important for institutional real estate portfolios, where those portfolios used to be just office, industrial, multifamily, and retail, a little bit of hotel sprinkled in, but now they're venturing into many, many other property sectors. And that's shown here in terms of how this organization that I work with, NCREIF, the logo on the bottom right, NCREIF, is going to be including things in their core index, the index that is kind of used as a benchmark for a lot of institutional investors. So you see that in the residential category, which used to be just the apartments and student housing, now and maybe some manufactured housing was in there, but the big new one is single family rental. So single family rental is going to be tracked, and that's just become an important sector for a lot of these funds. They're low risk funds for the most part, but they're including single family rental because that's a way to diversify. And as many of you know, that's been a hot investment category in recent years. Maybe there's some controversy there about institutional investors owning single family rental, but certainly it's becoming more and more important to include in institutional investment portfolios. You also see that life science is, and this wasn't done before, separated into industrial and office. So you could have office life science and you could have industrial life science, because some is more industrial in nature, some is more office in nature. One of the biggest changes is self-storage is going to be considered a property sector on par with these other main categories, because there's just a lot of self-storage investments. And then all these other categories that used to not be included in the index, even though the data was collected, are now going to be in the main index. Data centers and operating land where it's not farmland or parking, it's land is generating some income for some reason, or it could be where there's a ground lease on the property, and so it's generating income because there's a building that's the owner of the building is leasing the land or some kind of entertainment. Well, entertainment separate from the operating land, and then as is parking. So a lot of interesting changes taking place in terms of what's being included in a lot of the institutional portfolios that the Blackstones and Morgan Stanleys and JP Morgans and CBRE, Invesco and LaSalle Investment Management, and all the institutional investors, the kind of funds they're investing in, and kind of properties, I should say, that are being included in the fund. So you can see the growth in these other categories that are being added. the chart in the upper left is showing how it's gone from 20 billion, those extra categories that I mentioned, like the self-storage and others, gone from 20 billion, up to over 60 billion. So it's like tripled since 2017. It's still a relatively small percentage of the overall portfolios. It's gone from like a little over 3% to a little over 6%, but that's doubling. So it's certainly been the category that's been increasing the most. This is just kind of showing the changes in the composition over time of each. Although it looks like, if you just look at this quickly, it kind of looks like self-storage is shrinking. That's not really what's happening in terms of the total, because remember, the amount of capital invested in all these has tripled over the past like 5 years or so. So this is just showing the percentages. So the percentages have gone down for things like self-storage because there's been a lot of other things that are being added to these portfolios, like the life science and medical office and senior housing and so forth. But these other, as I've been referring to them as alternatives, have been doing pretty well. Everything is down the last year or so, but you'll notice that the returns are higher on the top chart where it says the alternatives are going to be added to the index. You notice that those are higher. They're less negative, but that's always good. Not good to be negative, but good if it's less negative, right? So in other words, you would have had a little better return if you would have had more self-storage and more life science and senior housing and student housing, et cetera, in your portfolio. It's not a huge spread over all the other sectors as shown in the bottom right. We're talking about basis points differences, but sometimes basis points really matter when you're multiplying by portfolios that are $1 billion. So leverage returns, of course, are negative. No surprise there. We already talked about that. As the unlevered returns start to go down below what you're paying in interest, your levered returns are going to drop even more. There are properties that have loan-to-value ratios greater than 1 that's been increasing. I was surprised when I looked at this over the whole history of the index that there were always properties with LTVs greater than 1 in a portfolio, and I think that's because if you're going to get a loan on a property, but you're not going to borrow on all the properties in your portfolio, you may as well max out on the ones you are going to get a loan on. It's costly to get a loan, so better to get a large loan on one property than 2 loans on 2 properties, as long as you're not getting a super high loan to value ratio. But then if you push it real high and property values do end up falling a little bit, you end up with the LTV greater than 1. But you could say it's been creeping up over the last couple of years. We hear a lot about concerns about debt coming due. But notice I started the scale here in 2017. If we go back to 2000, okay, you'll notice we're nowhere near what it was during the financial crisis. Okay, I mean, there it jumped up to over 600 loans that had LTVs greater than 1, with a lot of those loans being returned to the lender because they're non-recourse. Whereas now, yeah, it's crept up a little bit, but nowhere near what we saw then. In fact, nowhere near what it was back in 2017-18. So sort of a jump up there. Not much of a change during COVID, kind of surprising. So at least based on that activity, it doesn't look like there's a huge concern about loans coming due, at least within the institutional investors. But I've been hearing that a lot, that the concern about loans coming due maybe a little overdone. Lending activity, this is another chart from CBRE. The point here being that it looks like lending activity stabilized in the 4th quarter. So yeah, it's down, but it stopped dropping. It's kind of stabilized in terms of the lending activity. And what's happening, I don't think I have a chart on this, but you just have a lot more non-bank lenders in the market. In fact, this same organization, NCREIF, has started to collect data on debt funds. It's preliminary, but they've collected data now for a year or so, just to see, kind of how well it'll work to eventually have an index on the performance of debt funds. So these are private equity funds that are investing in debt, whether it's first mortgages, mezzanine loans, just all kinds of stuff, which is one of the issues is debt tends to be a mixture of a lot of different strategies. Debt funds tend to have a lot of different strategies. But my point is that these private equity debt funds seem to be filling in the void created by a lot of the banks not being as willing to lend money as Jeff said. The banks have become stricter, but the private equity funds, although their rates may be expensive too, but the capital is there. The capital has been there from these private debt funds. I put this chart in, although I don't have a good explanation as to why the holding periods have been changing, but nonetheless, it's interesting that holding periods had kind of peaked out in 2000 and then dropped, and then we're steadily dropping until the financial crisis. I suppose it makes sense that as we went into the financial crisis, you didn't want to sell. Institutional investors don't like to sell when values are down a lot. So you see holding periods going up. This is how long they had held it and until this year. So as they started to sell properties, the holding periods, or as they stopped selling, I should say, the holding periods got longer. It kind of crept up until COVID, where you see it dipped a little bit, and then has been going up again. I guess based on what I just said, you'd expect that the holding periods might get longer as they have been, as we're in a little bit of a down market right now, and so maybe you're not so anxious to sell those properties in the current market because you think it's going to recover. May as well wait for another year. It is interesting how the allocations across the different sectors have been changing over time. Used to be that office was the major component of institutional portfolios, up to 40% at one point. That's shrunk a lot, both from values declining as well as just less interested in adding office to the portfolio, whereas apartments have probably been the category, well, maybe a race between apartments and industrial in terms of adding to the institutional portfolios. And then retail really started to shrink as the REIT market took off, and a lot of the publicly traded REITs like the Simon Property Groups acquired a lot of those retail properties from the private market investors, and that's kind of shrunk over time. As we look at real estate pricing, we know that cap rates have been going up, and I always show this, that cap rates tend to be highly correlated with your BAA. So, if you kind of keep an eye on what's happening to BAA yields, probably an indication of what's going to happen to cap rates. That spread widened the last year or so, but if you look at the history, you see they usually come back together, and you do see the BAA starting to drop a little bit as cap rates have started to go up, and I wouldn't be surprised if those didn't come back together. A lot of people look at 90-day treasuries, but those don't seem to really tell us much about what's going to happen to cap rates. That spread is just all over the place. Even though it's on this chart, if I was going to pick something to try to give me an idea where cap rates might be headed, I'd look at the BAA yields. One of the guest speakers when I did the similar webinar last week put this chart in to make the point that we are really relying a lot more on price appreciation over time. Going back to '83, you kind of see where Even though it bounces around a little bit, the return that we're getting from income has been dropping. The return that we're getting from the price appreciation has been more and more important to our total rate of return. And I think that's reflective of a falling cap rate environment and falling interest rate environment that we've been in over much of this time period. So his point, which is a good one, is that may change going forward. We may not be able to expect that it's going to be a falling interest rates that are going to help us, at least not falling to the degree that they had been over such a long time period. Hopefully the Fed will start to lower rates, but not the kind of rate environment that we had been seeing. So Oxford Econometrics, should have them as a source here on this one. That was also one of the guest webinar presenters in my last webinar. Had the forecast for 10-year treasuries going out through 2029. You know, he's braver than I would be in trying to forecast interest rates, but you can see that you know, rates are expected to come down from where they've been. So 2024, they're probably going to be down a little bit from 2023, but continue to decrease back to more like a longer term average of 3.35%. If we look at cap rates again, you see that they have been going up. And if you look at cap rates for those properties that actually sold, again, a relatively small sample, but those do tend to be higher. In part, you know, I think just because you know, those properties you're going to sell in order to make them attractive and get them sold, you need to be willing to accept a little bit higher cap rate. So the buyer, you know, is getting a little bit of a premium over, you know, what they're being appraised at, buying it at lower than the appraised value. And this shows over time, another one from CBRE, but looking at some Green Street and other data sources, what the cap rate has done. And then also the expected unlevered IRR that people were expecting on properties. And so expected returns have been going up as cap rates have been going up, which makes sense. In fact, the cap rate is really driven by the return that you need to have, but then lowered by how much growth you expect to get. In other words, the difference between the green line here, your IRR that you want on a property, and the cap rate investors are willing to pay is mostly what you hope to get in growth in the income and value on the property. That's why you're willing to buy a property at a lower cap rate than your return, because you expect the growth to pull your return up. But what's also being pointed out here is the spread between the two kind of widens all of a sudden. So something to kind of keep an eye on going forward. And also the spread between the going in and the exit cap rate has really been narrowing in recent years. So let me explain that a little bit. This also came from CBRE, and I thought was really interesting. There wasn't enough data during COVID. So you see it kind of picked up in 2021, which we can kind of focus on 2021 going forward. So this would be like in a discounted cash flow model where you're projecting out your cash flows and then you're projecting a resale price at the end of the holding period. You estimate your resale price by using a cap rate, but we call that an exit cap rate or a terminal cap rate. I see the word terminal cap rate more often than exit cap rate. So how does that compare to what cap rates are today? And usually we say, well, the exit cap rates are going to be higher because the property's going to be older, and so there's not going to be quite as much growth, and it's also hard to project what income is going to look like 10 years from now when we're going to sell it. So we need to have a little bit of a premium in there. I think it's good that that spread has been dropping, which means, well, let me back up. One of the reasons also that you would have a spread between the going in and in the terminal would be if you think growth is not going to be quite as good in the future. So if you're not going to get as much growth, whether it's because the property is older or because of the economy being worse, then you need more of a spread between the going in and terminal cap rate. So that's why I was starting to say is that spread narrows. I think that's a good sign because it shows more optimism that there's going to be growth in the future. And even though properties may be older when we sell them, we expect the economy is going to be better when we sell them. So we don't expect that there's going to be that much of a premium in cap rates when you go to sell the property as the cap rates we're seeing on properties being purchased today. So I like seeing that spread narrow. It's the first time I had seen a chart that showed that data, and I thought it was quite interesting. So we like to do some polling questions, Jeff. Where will values be by the end of 2024? Are they going to be somewhat lower? So we're not really going to have a recovery at all during 24. It's going to get worse. Or will they stabilize at the current level? Or will they be somewhat higher by the end of 2024? Or you have no idea, and that's okay.
I'll keep the poll open for a few more seconds. We're getting some fast responses in, so if everyone could take the time to give us your opinions, we will have a tally and turn it back over to the discussion.
Oh, it's really interesting to see what everybody thinks. I suspect it'll be split between B and C, but we'll see.
All right, let's wrap it up. I think we have maxed out here. I'll share the results. So it's actually A and B here, Jeff.
Oh, really?
Yeah, so values will be somewhat lower by the end of 24 to stable, 40% each, and somewhat higher, 20%. So
okay.
Everyone has an idea in this case. No one had no idea, that's different. Last year there was, I think, I have no idea was the winning ticket. But
yeah, I think there's more optimism now, or more of a feeling that we know when things are going to turn around, because the Fed is talking about lowering rates, and more people are saying that maybe it's not going to be in 24, but should be in 25. So and maybe we do need to go a little bit lower before we recover. There does tend to be a lag in real estate markets recovering as the overall economy improves. So it'll be interesting. This shows returns again based on the appraised values across the different property sectors. How that's kind of changed over time. All kind of negative, especially for the quarter ending December 23. But as I talked about before, rent growth has been holding up quite well, and NOI growth actually jumped up quite a bit this quarter. It had been dropping off, and a lot of that was what I was seeing was expense growth, where the insurance and utilities were going up. There's a lot of seasonality in this kind of data, but it was really the, as I recall, insurance costs going up that was really hurting NOI growth, especially in third quarter of 23. But NOI growth is really up to a pretty decent level. So it's really those cap rates that are causing us the most consternation. The occupancy is down a little bit, but nothing like what we had during the recessions that we've had in the past. So occupancy has been holding up pretty well. So there's some slides here from Oxford Economics that does a lot of forecasting. And these are from, again, the webinar that I did a week ago. So not my forecast, but they're forecasting, I guess, consistent, Jeff, with what we just saw in our polling, that maybe down in 2024, but recovery in 2025 and then staying in positive territory 26 and 27. So they forecast, Oxford Economics, which kind of specializes in these economic forecasts, that values are going to recover in 2025. And you can see the commentary that they have over to the right here. So they project NOI yields will expand, you know, and things are gonna look good as we get into 2025. Now I've got some charts after this with their forecast for different sectors, but let's see what you all think first, and then we'll see if they agreed with you as to which property sector you think is going to perform the best. So is there going to be apartments, which I see mixed signals on, but a lot of people think apartments are going to do well. Hotels have been, actually, haven't talked about those much. The strongest, they've had positive returns the last couple of quarters. Industrial, which has been hurt the least. Office, which is, I'd be surprised if anybody votes for office, but maybe it's already taken a hit, or retail, which has been recovering nicely.
Just how the last vote's coming in. Close the poll. Here we go. So three-way tie.
Really? Wow.
Apartments, industrial, and retail all at 28%. An exact tie. That's very, very interesting. Followed by hotel at 12, and someone did come in at the last minute for office with 4% of the vote.
That's really interesting, and I think that's probably good. Have more of a divergence in opinion. That's what makes a market, right? And you know, we did this. I think with this group and with the institutional investors for a while there, it was like everybody was just picking industrial, you know. So everybody going into the same property sector, that herd mentality. I'm not sure that's as good for the market as what we just saw among this group. That more of a divergence of opinion and the support for at least 3 of the sectors, if not 4. So that's good. So what does Oxford Economics project? Also saying most yields are not going to return to the pre-pandemic levels that we had, but that was because we were in just an artificially low interest rate environment. So they do see positive yields. I'm not sure why they see the yield of industrial being negative, except that, you know, supply is going to catch up and maybe the demand will go off a little bit. And the same with residential. They see a slightly negative yield on the residential. These are differentials. Okay, so it's not. Maybe I might have just said that wrong. It's not that the yields will be negative. It's just that they won't be what they were before. So it's the differential from what we saw in 2019. So office will be a lot higher than what we saw in 2019. Okay. Yeah, this makes sense. Industrial will be not as good as it was in 2019 because industrial was obscene yields back in 2019. We were seeing for institutional owned real estate, you know, yields that were like, you know, close to, you know, 16% and a quarter. I mean, just crazy rates of return with properties, you know, coming in with appraised values that doubled from, you know, several quarters ago. And so to have those yields come down makes sense. Residential, single family especially, has been going strong. Those yields coming down makes sense. And the office, this doesn't mean office is going to have the highest yield, but it's going to recover the most. And of course, it's got the most to recover. So yeah, I think this makes sense. Okay, so they do think total returns are going to be positive in 2024. I'll see what you all think here in a minute. I think that's one of our questions, but they forecasts that all property returns will average 3.5% year over year for 23 to 27, which is not a real high internal rate of return, but at least it's going to be in positive territory during that time period. And investment activity, again, CBRE seeing investment activity. This was based on a survey, so you could see how many people were saying that activity in both buying and selling is going to be either up more than 10% or up to 10% or about the same and so forth. And so you can see both buying and selling activity is projected. I guess the winner is more than 10% for buying. Along with buying, you've got people selling, right? So no surprise that that's up as well. I guess about the same is the highest in terms of selling activity. So more interest in buying than selling is good, right? Because that's going to drive prices up. So for those of you that are brokers, which is probably most, if not all of you, we expect to see increase in investment activity and transactions taking place. And the projection is that should happen actually to some extent in 2024 during the second half of the year. Okay, so even though we think the recovery is going to be more towards 2025, it seems like in terms of investment activity, that's actually going to pick up sooner. That kind of makes sense because you don't want to wait until the market's already recovered to start buying, right? And I have been hearing institutional investors say, hey, I don't want to miss the market recovery. Then it's too late, right? Just like if you weren't in NVIDIA before today, you missed it, right? So you don't want to miss that uptick. So I think people are starting to come in or will come in the second half of 2024. The first half of 2024, you don't see much, right? That's the 9%, but 54% for the second half of 2024. So get ready for the second half of 2024. Make sure you got all your data in RealNex, right, Jeff? So you're all ready to contact, track those properties, and you use the time that you have now to get your database in shape. Because as we have learned or are learning that having a good database is what keeps you competitive. So what will be the return for investment grade real estate? So you can add something or subtract something into all these as you think about the answer if you're thinking more non-institutional. But are those returns going to be lower than -5% for this year? Or are they going to be -5% to 0? Are they going to be 0 to positive for this year, or greater than 5% for this year? Let's see what everybody thinks. My guess is, based on what we saw up to this point, some A and maybe the most in B, but some in C, and maybe one person will vote for D. Who knows? Let's see.
The group is much more optimistic than you are, Jeff. So that's a good bullish audience here. Where so let me just give it one more minute or second. There's a couple more people are coming in, but look at it. It's interesting. The vast majority are at 0 to positive 5%, and then even greater than 5%. So 79% are in the bullish camp, and only 21% are in still a negative perception mode.
Good. And to be clear, it wasn't me being pessimistic. It was trying to guess how they were going to vote. So I didn't do a good job of guessing how they were going to vote. I think I'll agree with them. I'll be just as optimistic. I see a lot of positive signs, especially if you look at what's happening to the stock market today. You still have the Fed projecting the lower interest rates. We know that NOI growth has been holding up. We just need those darn cap rates to stabilize and start going back down again. So returns do continue negative territory for the 5th straight quarter, and market values falling. But and hotels, although I didn't really show much with hotels, have had positive returns. Office continues to be the biggest drag, but it looks like even office could start turning around. Rent and NOI growth holding up surprisingly well. Percent leased, in other words, your occupancy down a little bit, but not much. Cap rates continue rising, but I don't see why they shouldn't start to fall later in the year and in the next year. And although properties with LTV greater than 1 are increasing, it's nothing like the financial crisis. And even though we hear a lot of concerns about the debt, maybe that's more the media. We'll see, but certainly from the people that I've been talking to, the capital is out there, both equity capital on the sidelines. There's dry powder, and there's debt funds that are stepping in and making debt capital available. So, and I think we have more visibility now into when the turnaround is going to take place than we did a year ago. As Jeff said, last time we did the survey, a lot more uncertainty as to when things might turn around than we had from the group today. All right, Jeff, any final comments you might have?
No, that's great, Jeff. Great coverage. Great to see the optimism in the market for the turning of the tide. It seems like activity is poised to pick up. Values are poised to stabilize, if not to begin to slowly and then to more gradually pick up, which is all good news. And the RealNex platform is here to serve you and help you get in front of it. So next week we will have a webinar on prioritized prospecting. We've done a lot of work embedding data into the RealNex platform, as well as to leverage that with some predictive analytics that help to forecast. As Jeff talked about, there are metrics with regard to holding periods for different types of assets, for different types of ownership, and with our RX data, we've embedded models in that model typical holding periods based on asset type and ownership to predict when those assets might trade, and looking at loan maturities and what those loans are based on as far as rates and how they compare to current market is another predictive tool. So we're really trying to hone the RealNex data and the RealNex system to give you prioritized prospecting methodology, so you can all your calls can be to people that are in the market, not the 95% that might be on the sidelines, but those 5% that are ready to trade or looking to engage. We are appreciative of your time, Jeff, and your observations and sharing with us your insights into the market, and thank you all for attending, and look forward to seeing you all back here next week and at future sessions on the RealNex webinar series. Have a great afternoon.